Daryl Jones, good afternoon. I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the third segment for the first day of the Investing Summit. We now have Darius Dale on, who's a senior analyst on our macro team. He's going to touch on for about 15 minutes our top three macro themes, and then we're going to get into Q&A. So we have a lot of time for questions and answers. So please fill up the queue, and we'll try to get to everything. Thanks.
Yep. And I'm sure one of the questions is, where the heck is Keith? Keith is dealing with a family issue today, but he will be back tomorrow, he confirmed. So appreciate you guys sort of bearing with Daryl and I, the B squad, but hopefully we get you the information you need to make some interesting decisions, because we are at a very important turning point for the financial markets. So again, we've been going through this full cycle investing deceleration, both the U.S. and the global economy. The global economy for the better part of 2 years now, the U.S. economy for a little over a year now, rolling off those 3Q18 peaks. And the real key question is for investors is the market getting ready to rotate into a more quad 2 reflationary type sort of bias, or are we going to rotate into much more of a quad 3 stagflationary type bias? So we'll walk on to what we'll walk through how we think about that positioning and as it relates to your asset allocations, and then sort of to open it up for questions. So just jumping into the process here on slide 6, the bread and butter from the bread and butter with respect to our econometric forecasting. So again, we care about trending rates of change and growth and inflation, and looking at the world through differential terms. What regime are you in? Are you in quad 1 where growth's accelerating and growth's accelerating, inflation is decelerating? That's market Goldilocks. That tends to be really positive for risk asset markets. Are you in quad 2? That's growth accelerating and inflation accelerating at the same time. That's that box there in 4Q19. That's what our projections currently have, that that 1 quarter blip into quad 2. But again, there's a myriad of downside risks, which we'll touch on, which sort of have us thinking that could ultimately now cast itself into quad 3, which is a scenario which is a much more late cycle stagflation scenario where growth's decelerating and inflation's accelerating. And then lastly, what's been priced into the markets from a trending perspective is a sort of quad 4 Q3 dynamic with respect to bond yields, with respect to gold, with respect to the outperformance of defensives over cyclicals within the equity market that obviously continues to manifest both in sector and style factor leadership terms. So again, you're just hitting on that box there. That's driven by our comparative base effect model estimates, which we'll touch on later in this presentation. But just jumping over to slide 8. So why do we think about the world in those regime-based, from a regime segmentation perspective? Because it allows us to backtest asset market performance. And what we've seen is that backtesting asset market performance, there tends to be certain types of assets that are really favored in each regime. And obviously in quad 4, what you tend to see is that outperformance of defensive, sectors and style factors in both the equity and credit markets. You tend to see strong dollar. But then when you flip over to quad 2, if you sort of go from quad 4 to quad 2, it's effectively the opposite. And which makes sense, because quad 4 is when growth and inflation are both decelerating. Quad 2 is when inflation and growth are both accelerating. So there's a real sort of anxiousness amongst our client base and amongst the general investor base, which either is overweight duration and across sort of various asset markets, or they're being forced to be overweight duration. Just from a career risk management perspective, either or, you can make the case that after bond yields have collapsed 143 basis points on the 10-year year over year, that pretty much, if you're still sitting in a seat, certainly as an institutional investor, you've definitely found a way to be on the right side of this eventually. Clearly we've been making this call for over a year now. So that's been a good call from that price point. But certainly, the investors are concerned about, potential sort of backup in interest rates that could, leave them really overweight, sort of underweight, and really exposed to some pain associated with a recovery in cyclicals, and obviously deterioration in the prices of bonds and bond proxies. So, that is a real big question. So the question we have to ask ourselves in helping investors sort of time and sort of sequence these phase transitions appropriately is where are we in the cycle? What's the probability of that quad 2 manifesting, and how is it ultimately likely to be priced in asset markets? So jumping to slide 25. So just hitting on our top 3 themes here for Q4 of 2019. So quad 4, then is it going to be quad 2 or quad 3? If you just go by the base effect model, the 2-year base effects say quad 2, but pretty much every other indicator, whether you look at a 3-year base effect or there's other indicators that we want to highlight as well, more than likely quad 3 is likely to be the ultimate nowcasted outcome. Number 2, EPS slowing. So we're finally getting to the most negative point as it relates to the year-over-year rate of change in earnings. Just the quick update on there. 22 companies have already reported Q3 numbers, and the earnings growth is down 13.3% in aggregate. We don't think it'll stay down 13.3%, but certainly down 5 to 8%, just based on our our analysis with respect to operating margins would seem to be quite reasonable and quite feasible. That compares to consensus only expecting down 4%. So that could be some serious downside surprise there as it relates to that. What's been happening, this dynamic, you've seen companies lower the bar and then ultimately step over a much lowered hurdle. And in terms of these beats, we think that the risk of that stopping or at least ceasing here as it relates to the Q3 earnings season is actually quite high. And then lastly, inflation accelerating. So what do Quad 2 and Quad 3 have in common? They both have inflation bottoming and rising from a trending perspective. So definitely we wanted to sort of highlight some of the key drivers of that view and how it's ultimately likely to impact asset markets. Because most people hear inflation, they go, oh, you got to sell bonds, you got to sell bond proxies, but that's not necessarily the case depending on where you are with respect to Quad 2 or Quad 3. So just getting right into it on slide 27 here. We're just showing our GIP summary table. It's probably easier if you put the whole slide up. So again, if you sync it to the world in rate of change terms, and you understand what quadrant each country has been in from a trending perspective, and also what the most likely quadrant is on a go-forward perspective, what you see is that two things you see: the global economy has been slowing for the better part of 2 years now. And in fact, in places like Europe and China, it's slowing against receding base effects, which is obviously evidence of much more secular sort of headwinds. And then secondarily, the comparative base effect models for large parts of the global economy suggest growth and inflation are likely to bottom in Q3 and inflect higher into Q4 and really into the better part, into the first half of next year. Now, how much confidence can you have in those estimates given where we are in the cycle is really the key question. If you jump to slide 29. So I mentioned the 2-year base effect versus the 3-year base effect. One of the reasons we think that the 3-year base effect, which continues to steepen in most of these major economies, particularly the U.S., Europe, and China, is a function of it pulling back into the observation window the impact of the Shanghai Accord. And so what we're showing here is the credit impulse, the red bar, and the black bar is the fiscal impulse, and just showing sort of China's major stimulus initiatives and comparing them in impulse terms. And what we mean by impulse is the trailing 2-year percentage point change in those particular indicators. One, the private financial sector credit to GDP ratio, and ultimately the fiscal deficit to GDP ratio. So what you saw is that the Shanghai Accord was it's a really big policy initiative as it relates to the credit and fiscal impulses that we saw in China. But again, if you adjust for the fact that China as an economy, as a share of global GDP, was effectively more than double what it was back in 08-09, this was the biggest stimulus program in the history of China. By all intents and purposes. So you really do have to contextualize the globally synchronized recovery of 2016 to 2017 through that lens. We definitely think that it's not an inconsequential sort of comp, so to speak, if you will. And so if you go to slide 30 here, so on slide 30, we're just showing the U.S. Comparative base effect model with respect to GDP growth in the United States of America, and then ultimately the 3-year base effects on the right. And what you see is that if you believe the 2-year base effects, we're effectively we're good at the Fed has engineered a soft landing. If you believe the 3-year base effects, we're still comping against what is the biggest stimulus in the history of China, and ultimately corporate tax reform in the U.S. that perpetuated those upsides and that divergence that we saw last year between the U.S. and the global economies. Same story in China. If you look at slide 31. Same story in China. So base effects have been receding for a couple quarters now in China, but China's actually slowing at its fastest rate against receding base effects. And that's because if you look at it on the 3-year, which again appropriately contextualizes the positive impact of the Shanghai Accord and U.S. tax reform, China's likely to continue slowing well into the beginning part of next year as well. Same with Europe. So again, if you again, it's all about the math and associated with the comparative base and the changes in the comparative base that get you these forward outlooks. These are leading indicators, and they're effectively saying that the global economy is very much unlikely to recover. If you believe that was an artificial sugar high, and we're still working through those distortions, the global economy is unlikely to recover in Q4 and potentially not well until not well into 2020. So that is a real big issue, and that's certainly something that we continue to suggest that investors may not that we continue to sound caution on this sort of this fear about a Quad 2 rotation because of that. Because if that comes to fruition, it's very unlikely that the markets and the machine itself will start to perpetuate an outperformance of cyclicals, particularly some of these more high beta beaten down names within the index. Jumping over to slide 35, there's a couple slides here that's really important. So the strong dollar has been crushing the Chinese economy from the perspective of financial tightening. One of the ways we sort of sequence this is through the lens of the reserve requirement ratio vis-a-vis the interbank lending rates. China's basically pancaked the reserve requirement ratio 400 or 500 basis points over the sort of last 18 months, but we've seen hardly any response in interbank lending rates because there's no liquidity actually being sort of input into the system. And you can kind of sort of see this, 4/5 of all credit in private non-financial sector credit in China is on bank balance sheet, and we're seeing that slow to a new cycle low. In fact, that 12.4% year over year for Chinese credit growth, that's the slowest growth rate we've seen since May of 2005. So, China's slowing at its fastest rate. We got these import and export figures out this morning. On the import side, Chinese demand down 8.5% year over year in September. That matches the cycle low growth rate that we saw in May. So effectively, everything's getting worse at its fastest rate because the strong dollar is sort of keeping the Chinese monetary authorities from effectively doing what it could do back in the Shanghai Accord days. So ultimately, on slide 36, what this all boils down to is is the Fed going to get dovish enough to really get the dollar off its highs and really send a signal to not only the Chinese economy, but also to domestic credit markets and to emerging markets, to central banks worldwide, that they can finally start to go and finally start to be much more aggressive with policy, particularly on mainland China. What we're showing here is the Fed's dot plot in the green line. The dot plot relative to something like overnight index swap spreads or Fed fund futures, the implied Fed funds target rate for the market-based target rate is a full-blown rate cutting cycle. The Fed is telling you that the Fed, whether you look at Powell's language last week or the week before that, or you look at the dot plot itself, it's telling you this is a mid-cycle adjustment. We are not this is not a mid-cycle slowdown. This is a late cycle slowdown that they could potentially stave off recession by being more aggressive on the monetary and fiscal policy front. But to make no mistake, this is certainly not late cycle. And a couple more things that I want to sort of highlight before we go to the next theme is on slide 38, this sort of sequence through 38 through 40. What we're showing here is the trending change in initial jobless claims on the left. So clearly late cycle by any historical measure, just based on the level of jobless claims. But also, if you look at the spread between the U6 rate and the U3 rate domestically. So the U6 rate captures underemployment and people who are sort of part-time, sort of marginally attached to the labor force for sort of economic measures, and the U3 headline employment rate. Just that spread is where it is now. It's historically been a signal of very late cycle wage inflation dynamics, and you're actually seeing this on slide 39. You're seeing private sector wage growth sort of hang out at cycle highs, even though employment growth itself is starting to slow at a faster rate, which always happens late in this business cycle, right? You just run out of people to hire. You can't hire people who don't exist. So effectively, there's a natural progression towards the end of a business cycle where the employment growth rate starts to really slow. But you see that sort of the supply of labor kind of sort of creating a sort of upward lift on wages. And so ultimately the key takeaway here is on slide 40. If we're at that point in the cycle where wages sort of kind of leave the barn and unit labor costs kind of leave the barn, are we likely to see this corporate profit recovery that's effectively baked into the consensus expectations for Q4 and obviously in 2020? Urian earlier this morning sort of highlighted, he mentioned that S&P earnings growth for 2020 are projected to be up 10% year over year. Well, if we don't have a recovery in the global economy based on the 3-year comps and wages are still going to continue to eat into sort of corporate profitability and corporate operating margins, can you have that cyclical recovery in earnings that would be associated with a move into quad 2? So right now, we don't really have to guess. Just really quickly on slide 42. We don't have to guess. We can now cast all this. We're just showing manufacturing PMIs, but if there's an indicator that ticks and it tracks and it back tests with respect to GDP and financial markets, we sequence it from a rigorous quantitative perspective, and we know exactly when something's turning, and we just haven't seen either the market signals or the data turn. So that continues to cause us to lend pause with respect to this quad 2 view, because I ultimately think that's more likely going to wind up in quad 3 from a nowcasting perspective. All right, so just jumping ahead to the next theme, EPS slowing. So kind of just thinking about slide 54. It's kind of been just this FOMO thing with respect to the change in monetary policy. Obviously, the Fed pivoting very dovishly, very aggressively in January and throughout the year, incrementally throughout the year, has caused a sort of an inflation of multiples. But it hasn't. What's happened is the cycle continues to slow underneath the hood, and you're seeing sort of P's expand, but the sort of forward EPS assumptions actually continue to come down. We think they'll come down at their fastest rate over the next few weeks as it relates to earnings, resetting that bar lower, but also Q4 and 2020 guidance. So that's definitely something we wanted to call out there. If you jump ahead to slide 59, so you look at all these sort of global measures of where we are in the sort of where there could be more downside risk associated with earnings. You look at something like South Korean exports, which have been a harbinger for S&P earnings for years, continue to slow at their fastest rate. So there's clearly downside to earnings. If you jump ahead to slide 67, we're showing just sort of wholesale inventory to sales ratios. So again, you think about demand slowing, you think about a strong dollar, you think about sort of inventory to sales ratios being really high and the need to necessarily sort of cut price to drive incremental volume growth, or just see, if you hold firm on price, you tend to see sort of a demand erosion, which is exactly, what effectively we're seeing. If you look at the next two slides on 68 and 69, you look at durable goods, CPI, that's actually, they're starting to try to push costs to the consumer domestically, but on slide 69, we look at durable goods and the consumers. This is a University of Michigan survey that shows the buying conditions for household durables, or at least the consumer's willingness to purchase household durables, or their unwillingness as a function of higher prices, and then that's back at the '08 lows. And so your sort of consumers are effectively balking at the U.S. corporation's ability to pass through price, and so that's effectively, that you could come to a really negative outlook for earnings, both cyclically and secularly, as it relates to that chart between labor and profit. So just summarizing this on slide 73, we've long thought that the Q3 earnings season would be the worst of the earnings seasons. Again, I mentioned that the 22 companies that have reported thus far are down 13.3%. That 19 down 19% was from last week, obviously. But again, strong dollar, wage growth rising, demand falling, and in fact, demand globally, both domestically and globally, falling at its fastest rate per the most recent data. That doesn't necessarily portend a magical earnings recovery. We probably need to see some much more aggressive monetary policy out of the Fed to really get the dollar down and really start to create a sustained and believable expectation of inflation. Secondary, so just lastly with the third theme, skipping over to slide 76, inflation accelerating. So, there's two components to this theme. It's yes, inflation is accelerating, but does that necessarily perpetuate a sharp backup in bond yields and a sharp decrease in the prices of bond proxies and gold and things, these more defensive assets and sectors and style factors? That's really the big risk for a lot of investor portfolios right now, just given the trending outperformance of those things. So again, on slide 76, we're just showing our model for the U.S. CPI. So we have that backing up, back to a slightly above trend over the next couple of quarters. And on slide 77, Chinese CPI is sort of high and sticky. But you also have the similar dynamic to the U.S. occurring in the Eurozone economies. Now, those levels of inflation don't necessarily portend a change in monetary policy. In fact, if you think about, with the most recent prints we've gotten out of the European CPI, it's likely they start to actually double down into this scenario. If you think about German CPI slowing to 0.9%, this is the Friday numbers, slowing to 0.9% in September. Spanish CPI slowing to 0.2% in September. So you're effectively lowering the bar from which the acceleration takes place, which means the probability that the central bank sort of shifts in policy and really starts to signal sort of a reduced willingness to ease or increased willingness to taper and tighten financial policy or monetary policy. That's a lower that you remove some of that risk. So that's always something to keep in mind. Slide 78, we're just showing some of these base effect dynamics that could potentially get inflation much higher in short order here in the U.S. So you got food prices on a year-over-year rate of change basis set to markedly accelerate over the next few months. Same with energy prices as well. On slide 80, we have some idiosyncratic upside risk to inflation as well. If you think about wage growth in the Europe and Eurozone, on slide 81, swine fever in China, the consumption tax hike in Japan. Globally, inflation is set to accelerate, and the risk is to the upside there, but it's not necessarily to the upside so much so that you're going to see a material change in monetary policy. So that's something to keep in mind as it relates to bond proxies and things of that nature. So just sort of kind of finishing up with respect to the asset allocation shifts and pivots you want to be making on slide 86. The title of the chart says, the title of the slide says everything. Straddling the line between quad 2 and quad 3 is no place to be. I mean, that's the demarcation between growth accelerating and growth decelerating is a material shift as it relates to asset market performance. What we're showing here is our GIP model back test with respect to the U.S. The S&P 500 and 10-year nominal rates. And what you see is that rates, the market tends to be trending higher, and rates tend to be trending higher when you're in quad 2. But when you're in quad 3, you're talking about a choppy, directionless market. It's certainly choppy, flat to down bond yields effectively on a nominal basis. And that's the same with respect to real interest rates as well. If you jump ahead to slide 90, because one of the key risks to our view and our setup is that you get this material backup in real interest rates associated with the believable expectations of inflation that are driven by themselves the cycle. We don't necessarily think the Fed is there yet. We think the Fed can get there if the market conditions, like the kind of market conditions we saw at the beginning of last week, can really get them there in a hurry. Right now, implied probability on a rate cut at the end of this month and on the 30th is only at 72.9%. It peaked at 85.3%. So again, they're not even, the federal futures markets aren't even pricing in an additional rate cut. We think they need to go whole hog dovish, minus 50 basis points, signal some sort of form of QE. Stop talking that this balance sheet expansion isn't QE. Say it's QE, go further out on the curve. They need to do a lot more just based on where we are with respect to the business cycle, because the probability of getting a sustained recovery from this level from these levels of economic activity with respect to where we are in the labor markets and the labor dynamics in some of these key economies is really precarious. Just that's something to keep in mind. Just going back a couple slides on slide 88, 89, one of the places that historically have been a great place to be invested in when you're in quad 2 or quad 3 is tech, particularly growth specifically in quad 2, but tech in both scenarios. But again, we continue to call out the downside risk that's associated with earnings for this particular sector and style factor. If you look at slide 89, what we're showing here is just the software investment and the rate of change trend in that vis-a-vis the comps, and that's more than likely to continue slowing. Same with R&D spend. And so you almost have to wonder if a lot of these companies, particularly on the software side, get paid in per person per seat licensing, and all the revenue generation indicators are saying we're slowing, and employment growth is slowing, and corporate profits are negative. Don't forget that so much of what we've seen from a business investment perspective through the lens of software and technology has been a function of record corporate profits. If all these things are moving in the wrong direction, to me that's why the signal on the IVG is bearish trend. That signal is not confirming a quad 2 move, because if we're in quad 2, IVG, software stocks broadly and would be trending higher. That's certainly not the case with respect to how we're sequencing that from a quantitative perspective. So again, it's not you always have to keep the earnings outlook in mind as it relates to potentially finding places to be in quad 2 or quad 3. One of those places that we do like on the margin is on slide 92, and this has been left for dead. I mean, Keith and I were in Texas last week. We can't get people to talk about energy down in Texas, down in the oil patch. I mean, so certainly this has obviously been a beaten up sector and just a kind of left for dead sector as it relates to its share of the total index. But if we get if you go back to 2008 when oil hit $150 a barrel, you go back to 2011, the reflationary highs, amid slowing growth, amid quad 3. You could still see a cyclical outperformance in energy stocks and crude oil, and so that's something we, just given the lack of sort of the propensity of a down dollar, of the Fed finally getting the dollar to go down as a function of a sort of further quad 4 smackdown could really get this sort of trade reignited, and so that's something we kind of sort of want to keep in mind there. Just as it relates to on slide 94, there's one more before we wrap up. On slide 94, just kind of again going back to the headline. Straddling the line between quad 2 and quad 3 is no place to be. So if you're in quad 2, you tend to have credit spreads falling and long bonds declining in price, yields backing up on a yield basis. Well, that's the opposite in quad 3. And so it really does put the onus on an investor to say, okay, what part of I really need to be able to find a way to sequence whether or not the global economy is A, bottoming, and then B, starting to reaccelerate. Again, we're tracking tens of thousands of data sets on a daily basis across the global economy. So we have a pretty good eye on that. But again, the financial markets tend to lead, inflections in the data. And so such that the financial markets have not yet signaled an inflection into quad 2, we're going to stick with this growth slowing theme and this growth slowing narrative for the time being. So on slide 99, we sort of summarize our thematic investment conclusions. So what we're showing here is just what we'll start with number 2 is the trend, intermediate term trend. These are the positions that we've added at least 3 months ago or more. So again, just no change to that core asset allocation. When you think about utilities, REITs, long-term treasuries, short-term treasuries, there's probably more upside in the short term here. If you think about where the Fed could really start to get really more aggressively dovish, and which would obviously put a steepener on with respect to the yield curve. Gold itself, housing continues to do well. And then on the short side, industrial, financial, junk bonds, the Russell 2000, particularly small cap value, that tends to get hit when growth is slowing. Software, regional banks, and then hedge fund hotels. That always gives me a chuckle. But then as it relates to the things that we added, as it relates to this most recent presentation, which we introduced on October 3rd, TIPS is a fantastic place to be in either scenario, whether you're in quad 2 or quad 3. Quad 3 tends to see a pretty sharp decline in real interest rates. Quad 2 tends to see pretty big increases in break even, so TIPS is a great place to be there. Energy, Canada is one of the few places that tends to benefit from its equity index composition on a falling dollar and reflationary sort of impulse that, a la 2011, et cetera, et cetera. Not to mention Canada itself has one of the best, most positive GIP model outlooks in the world. Just broadening our ways to play inflation, so livestock, lumber, and on the short side, this is a lot easier. Just find things that don't do well in either Quad 2 or Quad 3, and one of those things is obviously consumer staples, telecom, legacy telecom, and then private equity, which tends to do pretty well or pretty poorly whenever credit spreads are riding. So that's a play on Quad 3 itself. So with that, I'll turn it over to Daryl for some questions.
Okay, great. A lot of great questions in the queue, and please put more in as you think of them. Some of these you've touched on already, but I think we'll just kind of go back to a few of the points. First one is, can you please explain your outlook for the U.S. dollar?
Please, absolutely. So if you go to slide 97 in this deck, so with the dollar, it's all about whether you're not in your Quad 4 or not. The historical back test in the dollar shows that pretty much the only quadrant where the dollar has a positive expected value is Quad 4, which is why we're seeing the dollar rise on a trending basis, because we've been in Quad 4 domestically and globally for quite some time now. So to the extent we can inflect out of Quad 4, and whether or not this is driven by a massive policy shift by the Federal Reserve, or a massive step towards incremental dovishness by the Federal Reserve, or if we just sort of kind of continue to decelerate and trend lower from that perspective, from a GDP growth perspective, we're either going to be in Quad 2 or Quad 3, which make the case that the dollar is probably done going up. We would agree with that view, certainly with the dollar from a perspective of CFD futures and options positioning. It's starting to get long in the tooth. It's not necessarily egregiously long in the tooth, but right now the net non-commercial positioning there is 40,000 contracts to the long side, to the net long side. That's on a 1 year Z-score basis. That's 1.4. You tend to see reversals in asset markets when you get around 2. So we're not quite there yet, but certainly from the perspective of how the data may evolve over the next few months, it's very likely that we get out of this Quad 4 dynamic and into a Quad 2 or Quad 3 dynamic, which should start to get the dollar down gradually or dollar down sharply if the Fed is appropriately responding to where we think we are in the business cycle.
Yeah. So you've been watching the Chinese economy for a long time, 10 plus years now. What have you learned studying the Chinese economy?
Probably the number one thing I've learned is, if you go to slide 36 rather. Oh no, 35 rather. If you actually 34 kind of sets up 35. So go to slide 34. What we're showing here, this is probably the most important thing I've learned, certainly in recent years, is that China is short dollars. China is increasingly becoming a more traditional emerging market. Now, it's not quite to the level of financial and economic volatility that we're going to see out of Argentina, Brazil, or Turkey.
So when you say traditional emerging market, what do you mean by that?
I mean just being perpetually short dollars and reliant on global capital flows to finance its growth.
Yep.
That's China for the longest time was effectively a net creditor to the global economy. Now it's becoming a net lender, which, going back to this chart on slide 34, that transition has taken place over the last few years. Secondarily, we all know is the red bar on the right chart. China's an incredibly levered economy by any sort of historical measure or any sort of cross-currency comparative measure. But what's really important about the Chinese economy that I think is so keenly underestimated and underappreciated is the fact that 4/5 of all financial leverage in China is on bank balance sheet. They don't have functioning capital markets. They just, you go lend there and you go lend there to state-owned enterprise A or B. And so that if you can just track the rate of change in credit growth, on bank balance sheet credit growth in China, you pretty much know with a 6 to 9 month lead time what the state of economic activity is going to be in China. So when I see that number that I mentioned earlier, credit growth slowing to the lowest level we've seen since May of 2005, and non-traditional financing, which is the other fifth, in China, continuing to contract, it's telling me that they're short dollars. The strong dollar is effectively is perpetuating a quantitative tightening on their system, so that they're much more reliant on changes in monetary policy out of the Federal Reserve to get the dollar down, to get them to be able to stimulate more aggressively. And we just haven't been able to do that. They haven't been able to do that.
Okay, this is a European question. We have Daniel Lacaille on tomorrow who'll go deep on Europe.
Brilliant on Europe.
This question is pretty straightforward. Is recession risk rising in Europe?
recession. Germany's already in recession, so I mean, I don't know if it's rising. I mean, you, by any stretch of the imagination, you look at PMIs, you look at soft data indicators. Last week we got the October Syntex investor confidence number. It's ticked down to minus 16.8. That's the lowest level we've seen since 2013. And so I made this point in my note on Friday, my institutional note on Friday. All there's 2 points you need to make. The hard data has to play catch down to where the soft data has been in recent months. So if you think about something this morning, we got industrial production out of the Eurozone. It was down 2.8% year over year, but that's an August number. It's going to get worse in September. It might get worse in October if this data point is indicative of the underlying trend. And so we have a couple more months of soft data playing catch down, which means we have at least a couple more months of monetary authorities in all these major economies saying, oh boy, we're slowing. We need to be more dovish. And so that's kind of one key takeaway there. But again, the second point is the soft data is still slowing. Whether you look at the PMIs domestically or globally, whether you look at measures of consumer and business confidence domestically and globally, I mean, let's just take a quick step.
Is the soft data typically a leading indicator for the hard data?
Exactly.
So that's the right way to think about it.
Exactly. So on slide 42, 43, and 44, the reason investors care about soft data, because one, it gets released sooner, but also it's the time lag.
It's more of a real-time survey.
Bingo. The time lag with which it ultimately sort of correlates to GDP and inflation. It gives you a lot of lead time to ultimately sort of sequence these things. But what you're seeing is that, whether it be PMIs, consumer confidence, business confidence, on a trending basis, all this data is getting worse at its fastest rate. So that's telling me that, okay, we're in October. We're receiving soft data for September, and now some of these soft data points for October, a couple of thus far, and it's telling me that the slowdown is extending itself into Q4, which reduces the probability of those 2s in that table on slide 27. Put that back up. It's basically saying, don't think about 2s; those are 3s.
And when will you see the hard data that will validate kind of what we're seeing in the soft data?
Well, it'll
Is that sort of the November timeframe.
The appropriate sequence really would be, when do the markets start to price in inflection? And from an intermediate term trend perspective, I wrote this down in my notebook, there's not a major macro market signal in the U.S. or global economy that suggests we're at the precipice of an inflection into quad 2. And just before, write these levels down, folks. On the S&P 500, it's 29.56. That's the trend line there. On WTI crude, the trend line there is 59.76. The 10-year, the trend line there is on the 10-year U.S. Treasury yield. That's 1.91%, and then the trend line for the dollar, which is bullish trend, is underneath the last price at 96.79. So the SPY, the 10-year, and crude oil are all bearish trend still, even after last week's aggressive move to the upside with respect to this sort of soybean deal, and then the dollar continues to be bullish trend as well. So something has to give in that regard if we're going to see an inflection in a quant 2 that's really painful and sustainably painful for duration risk across your portfolio. And that's the key question. Key thing we continue to call out is that we just don't see it in the data or the markets. I mean, the immediate term downside in the S&P 500 as of this morning, from the perspective of key risk ranges, down 3.1%. Immediate term downside to 28.75. 27 basis points immediate term downside on the 10-year to 1.46. You wouldn't be seeing these types of signals if we were in a new regime.
Yeah, exactly. So this question a little bit more on process. But how do you guys get to your outlook for an earnings recession in the U.S.? And I think what he's talking about is just sort of the math we look at that shows comparisons year over year and what we're comparing against right now.
Yeah, absolutely. So there's kind of two. We come from a number of perspectives. The most important perspective is thinking about the relationship between operating margins and how that flows through to EPS. Obviously, there's a lot of sort of accounting gimmickry you can play with respect to buybacks, and that's not something we're ever going to have an informed view on. But certainly we understand the operating margin dynamics. So you have kind of a trifecta of bearish things. Growth growth, both domestically and globally, is on its lows. If you sort of think about this in percentile terms, the global economy is on its lows, the U.S. economy is on its lows from a full cycle investing perspective. So that's number one. You obviously have inventory to sales ratios for a lot of sectors in the economy are actually at cyclical highs. So that portends lower operating margins from a future perspective as well. And then lastly, the dollar. I mean, the dollar is up 3.4% year over year as of this morning. Continues to just grind higher. Now, again, we expect it to peak out and inflect. Start to make a series of lower highs in short order if we do get this transition into quad 3, quad 2. We still think it's probably ultimately going to be quad 3, but as it relates to quad 4 being sort of priced into the financial markets and viewed by financial market participants, our own model suggests inflation could actually slow further in October before really accelerating into November and December. So it could be another month before the dollar really starts to sniff out quad 2 or quad 3.
Yeah.
So that's kind of how we get to earnings being down 5 to 8%. And again, it's not a precise precision estimate.
Yeah.
That's a scenario analysis. We actually don't have that scenario analysis slide in this deck. But that's a scenario analysis that said if you take S&P 500 operating margins down by 100 basis points, where would how did that flow through to EPS, and it'd be down to 5 to 8%?
Yeah, and I think also the important point on an earnings recession is the second derivative is that's when people start cutting heads.
Totally.
Like, so you're trying to manage your earnings, you need to cut costs, and that's when we start to see unemployment tick up.
Totally. Well, exactly. So two things always happen late in the business cycle, right? Well, as unit labor costs start to rise, which again is that super important chart on slide 40. I want everyone to burn that image into their head because that's got to be the most important chart as it relates to the not only the immediate term future for the equity and credit markets, but also the longer term from a secular perspective as well. Again, this green line. The green line is always high and rising into recession. This we know. You run out of labor, the cost of labor continues to rise and rise and rise until you ultimately have to fire people, to your point.
Yeah.
So we're in a CapEx recession domestically, through 2 or 3 consecutive months of down year-over-year core capital goods orders. Employment growth itself is slowing from a trending perspective. We're at the point in the cycle where that can actually start to accelerate to the downside just based on running out of incremental bodies to hire. So again, this is how the business cycle works.
Yep.
You start to threaten corporate profitability, and the decisions get made. The hard decision gets made. You cut back on CapEx, or you cut back on employment, or you cut back on both.
Yeah, exactly. So the next 2 quads are not in quad 4 based on your model. Should we be done with gold then for now, or will they continue? Or will gold continue to work after, even though we might be moving into a different quad?
Yeah, gold will work if real interest rates are going down. So I think if you go to slide 90. Slide 90 shows the back test on real interest rates, vis-a-vis tips and whatnot. You tend to have falling real interest rates, and this is a function of we've been in a bond bull market for 30 years. This is the lifetime of the back test is 25 years. And in this particular instance, we've been in a falling bond yield environment for a really long time, which is why gold for a lot of that period was in a bull market. You really only have to worry about sharp, sustained rises in real interest rates when you're in quad 2, particularly when you're meaningfully in quad 2. So what we're showing here in this analysis, if we put the left chart, the full chart up on the left here, the black bar represents the expected value of the back test of this particular indicator, obviously real interest rates in these regimes. So quad 2, you have a high expected value, a high positive return, with a high percent positive rate, which is the green line. Well, you're only narrowly in quad 2, however, the expected value for real interest rates goes down dramatically. And so what that tells you is that you tend to need to be fervently in quad 2 enough to signal a change in policy, or at least enough for the markets to start to anticipate a change in policy out of the Fed. So this sort of very narrow bounce into quad 2, which is implied by our 2-year base effect model, that's something that can actually sort of, that's not necessarily something that could get real interest rates to rise from a sustainable perspective.
Yeah, gotcha. So going back to the earnings point, a couple questions on this, but to what extent is the earnings recession or earnings decline already priced in? People are referencing some sell-side economists or whoever have taken down their earnings number. Do you think that's something the market has already sniffed out, this earnings recession, or is that something that's sort of still not totally priced in?
Well, it's certainly more priced in today than it ever has been, right?
Yeah.
Or at least at the lows of last week. If you look at just trending performance on sectors and style factors, looking at 3-month, look at the 3-month performance spread on something like low beta stocks versus high beta stocks.
Yeah.
And this is by quartiles of S&P 500 constituents. Low beta stocks are up 3.4%. On a trailing 3-month basis, whereas high beta stocks are down 7.8%. You look at sort of low short interest stocks down only 2.1% over the trailing 3-month period, whereas high short interest stocks are down 5% on a trailing 3-month basis. In fact, low beta is on a trailing 3-month basis is the only style factor that's up as positive returns. So I don't want to hear this. The market's at the highs. I hate these. Quite frankly, they're dumb questions. When people say the market's at the highs, but you're not actually sequencing it from a sector and style factor leadership perspective. If low beta min-vol securities are the only sector or only style factor that actually have positive trending market performance, that tells you there's a ton of deterioration underneath the hood that's associated with the cyclical reality that earnings are going to be negative year over year and through Q3, and that we've slowed to the lows, cycle lows in growth, both domestically and abroad.
Yeah. Actually, we talked about this slide this morning, so it must be topical for people, but the back test of gold for each quad. I think we have that slide where...
I don't think it's in this deck. We had it in the previous
maybe,
deck.
Okay. So maybe we can tweet it out or reference it tomorrow morning. Okay. When will it be too late? Again, a Fed question. When will it be too late for the Fed to go full dovish? Will we potentially hit a point of no return in terms of economic growth slowing?
Yes, that is the case if you go to slide 38. If the
where
Fed,
you're kind of beyond when they should have, it's sort of too late.
absolutely. So slide 38 is when jobless claims are rising and the Fed's going dovish, that is not a signal to buy.
Yeah.
That is a signal to not be long risk assets, because that means you're probably headed in a recession. Now, when you're in recession, you want to buy risk assets. That's when you tend to see, believable estimates bottomed out believable estimates. You tend to want to buy, cyclicals when they're expensive, and you would tend to want to sell them when they're cheap, quote unquote cheap at the peak of the cycle. So we, as a cyclically oriented investor who's sequencing growth and inflation to sort of front run major shifts in sector and style factor leadership across asset markets, we would welcome a recession. It'd be phenomenal. The problem where we are today that makes this exercise so difficult is because the Fed, in all its glory, thinks that we're still in mid-cycle from an economic perspective. We are not this is not 2015, 2016. That's the key difference this time around. Well, there's two key differences this time around as it relates to the last time we're on the lows in the manufacturing cycle, both domestically and abroad. One, there was massive stimulus initiatives, the Shanghai Accord, and then corporate tax reform in the U.S. And then two, we just weren't at full employment. We are in full employment now, so even if we did get major stimulus initiatives, how could that actually translate into economic growth if we have no spare capacity? So that is the key question. What if the Fed actually did go whole hog dovish and announce QE? What if we just kept slowing anyway, like we always do late in the business cycle?
Yeah.
So that is a key risk. So the longer it takes for them to finally capitulate with respect to monetary policy and acknowledging that we are late cycle and that they need to be more aggressive, the more deterioration that's happening underneath the hood from a labor cycle perspective.
It's actually an interesting question about our process, but from a historical perspective, have we been more effective at projecting inflation or growth? So is our model more typically more accurate on GDP or on inflation?
Yeah, no. So we are.
Or maybe there's no big difference.
There's really no big difference. So the nowcast models have an average absolute forecast there of 27 basis points intra-quarter, and a 85% success rate in terms of projecting the sign of the rate of change, i.e., is it accelerating or decelerating? So that's pretty damn good. I'd like to think that's one of the better models on the street. In inflation, it's 22 basis points from an average absolute forecast error, and then 83%. So we're slightly better at projecting the direction of growth, and we're a little bit better at actually nailing the button on inflation.
Yeah.
But both the models are effectively the same. They back test really, really well.
All right, so a few questions on this as well. One of our favorite sectors over the course of the year, but utilities. Has that played out?
It's played out in the sense that we can't get to further downside in the 10-year Treasury, both the nominal and real 10-year Treasury rate, which obviously has been sort of leading or dragging bond proxies higher. The price of bonds have been dragging bond proxies higher and gold higher, and so you can make the case that the best of times are sort of in the rearview mirror from the perspective of being just completely overweight duration, and that makes sense, right? You're transitioning out of quad 4 and into either quad 2 or quad 3, which tells you from an expected value perspective, from a percent positive ratio perspective, you're just going to have less good returns in things like utilities, things like gold, things like bonds, and et cetera, et cetera. But that doesn't necessarily mean you have losses. Losses occur when you go to quad 2, not quad 3.
Yeah.
So you could still actually make money in these things. You're just probably not going to do as well as you would in quad 4, which is a call that prescient call we made to get people positioned for quad 4 ahead of the quad 4 happening. So obviously the returns associated with that are just crushing anything in the market. I mean, the market this morning when I wrote it down was up 9% year over year, but utilities up 21% year over year, REITs up 22% year over year. So it's like what. When you talk about the market, what do you mean the market? What sector you're talking about? What style factor you're talking about? High beta stocks up 1.2% year over year. Low beta stocks are up 21% year over year. Would you prefer to have a 21% return or a 1% return?
Yeah.
That's the whole point about sequencing the cycle and understanding the real drivers of the markets as opposed to what the old wall media will tell you is the driver of the market is some trade tweet about soybeans.
Yeah. So this is a higher level macro-oriented question, but do you buy the theory that all the prior QEs in the past were unable to get inflation going because of capital misallocation? So the capital effectively went to the wrong place.
Yeah, the most deflation. Look, think about this in just Look at Japan.
Yeah.
They've been the most dovish central bank in the history of central banking. I mean, they've taught us how to do a lot of interesting things from a central banking perspective. But you know what that does? It keeps a lid or floor under aggregate supply in the economy. You don't have the natural sort of churn and sort of kind of innovation that you have, associated with recessions and associated with, having higher levels, a higher, sort of weighted average cost of capital throughout the economy. So everyone's in business, and so we can, why is the price of streaming media services so low?
Yeah.
Well, because everyone can just finance the growth of their content and their growth and their expansion of their content through the low interest rates and through cheap credit.
Yeah.
So you can sort of extrapolate that across every sector of the economy. As long as the interest rates are this low and as long as monetary policy is this easy, you got everyone in the game. And as long as everyone is in the game, we have a depressing impact on price because supply is obviously great.
What countries or sectors, for that matter, benefit from a strong dollar?
Well, the U.S. consumer will be the first and
For
foremost.
the first, so U.S. consumer oriented.
And that's what we've seen. I mean, you see the core retail sales at 5% year over year
Yep.
as a most recent data point. That was August data point. The consumer is doing just fine. But the risk of the consumer doing just fine, which is vis-a-vis where we are in the business cycle, is there's a lot of risk associated with that.
Yeah.
And I don't want to mince words. If we continue to, if we're going back to slide 30, if the chart on the right in slide 30 is the ultimate outcome that we see with respect to the U.S. economy, and then it's the same for Europe and Asia as well, we're going to get to the point where corporate earnings don't recover, and they're going to have to make corporations, C-suite executives are going to have to make incremental decisions on whether to start to fire people. Because certainly we're seeing employment growth slow already. We're going to fire people. We're going to reduce hours worked even further,
Yeah.
which obviously drives down aggregate demand in the economy, and then could be further curtail CapEx, which obviously has a deleterious impact on growth from a purchasing perspective, but also from the perspective of sort of reducing the outlook for productivity growth. So if that chart on the right is correct, this U.S. consumer is fine narrative. Well, one, consumer is 2/3 of GDP, so clearly it would be slowing in that regard anyway. But secondarily, you could really start to bring on a whole host of anxieties associated with that narrative, because that's been one of the rock solid things that's been underpinning
Yeah.
a lot of these expectations for not going into recession.
So we get asked this on the macro show quite often, but the chance that in the fourth quarter, it's actually not quad 2 or quad 3, but we stay in quad 4. I think the answer to that basically is the math doesn't work.
Yeah, that's a low probability event. I mean, the horse has kind of left the barn with respect to inflation. I think it's slide 85. I mean, I kind of walked through why we think inflation's going up, but it's slide 84. One of the things that we track here on is the sort of the 3-month annualized change in core and median CPI. I mean, we're at cycle highs.
Yeah.
In fact, to be honest, with respect, that chart isn't updated for the September data, but it's still at 2.72%. So the horse has left the bar. We're so late cycle. Inflation itself is a late cycle phenomenon. Wage growth is a late cycle phenomenon, and the relationship between wage growth and broader measures of CPI, that relationship really starts to, one of the cooler calls we've made in the sort of past 18 months was when we made that first quad 4 call heading into the Q4 of last year. We also had a view that wage growth would start to would sustainably accelerate and would accelerate through the end of the business cycle. So we got a lot of pushback on that. Okay, you're calling for inflation to slow, but wage growth to continue accelerating.
Yeah.
Well, if you sequence the U.S. economic history, you'll find that on a short to intermediate term basis, there's hardly any relationship between wage growth and core inflation. But on a longer term basis, i.e. trailing 24 months, trailing 36 months, that's when the relationship's super tight. And so we're getting to that point where we're going to be 18, 24 months in the future from that initial projected acceleration in inflation. So we're going to start to see all these core inflationary dynamics really be high and sticky sustainably.
Yep.
And this is something that obviously late in the business cycle can be really deleterious for risk assets.
Yep. So you talked about this a little bit, but just the fact that energy is so out of favor. I think we just for the first time added as either investing ideas or real-time alerts in a long time.
Yes, ETF Pro.
And this question is more about the idea of whether energy can go up in inflation. Can energy go up at the same time we have low yields and a dovish Fed? So what's the right macro environment for energy to go higher?
Yeah, the best macro environment for energy to go higher is quad 2.
Yeah.
So that historically has been very, very positive for investors' propensity and willingness to chase sort of inflation plays.
Yeah.
Everyone makes the case that, well, if you have demand continue to slow, let's say all those twos on slide 27 ultimately wind up manifesting as threes, i.e. growth continues to slow in all these economies. Well, everyone says, well, the demand's going to fall. Well, that's true. But one, crude energy demand is super inelastic. I mean, that's not the driver of energy. It's usually supply is the marginal determinant of price. But also, the energy is the most financialized asset in the world. I think it's the financial leverage in the system is about 20x what underlying energy demand is. The commodity is. So effectively, if you just get the investors' willingness to chase price in broader, sort of inflation hedge measures, then you can just get a rally in energy. That's what happened in 2008. That's what happened in 2011. This is why we're so keenly focused on the Fed, because the Fed might not get you paid in terms of resuscitating the economy and staving off recession, but the Fed can get you paid on the long side of inflation hedges this late in the business cycle. So this is something we're kind of keenly pointing out.
Yep. Okay. Great. We're going to wrap it up there. We have the next segment of the Investing Summit tomorrow at 11 a.m. and the speakers are Jeff Snyder, Daniel Lacaille, and then Liz Ann Saunders, who's always awesome. So hopefully you can join us tomorrow for 3 segments starting at 11 and ending at 2. Thanks, everybody.